welcome to the IndiNations 7 Generations Investing Podcast. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to get a little bit more in the detail of our tribal treasury playbook and kind of that time horizon model that we talked about with regard to establishing structure, investment structure, and investment allocations that fit your time horizon as well as your goals and your risk. So today we're going to talk about protecting tribal cash reserves, which is really just investing with liquidity and stability, because this is going to be your near-term bucket. And so we're going to talk a little bit more in detail about the investments we use, why we think this is beneficial, and how to structure those short-term tribal cash reserves. So let's get going. So what's the purpose here? And I think the purpose is, you can see on the left-hand side, the purpose is under all this near-term needs, whether it's near-term obligations like your operational budget or essential operations or maintaining service continuity for the things you're doing on a recurring basis. So establishing cash reserves that make sure that you can continue to do the operations that you've set forth as a tribal government, as a tribal business, or as a tribal foundation. Any of these are going to need, this is the lifeblood of your organization, really, is making sure you can meet the obligations so you can continue to run your operations successfully. The second part about this is kind of the bottom 2 points, is bridging that revenue disruption and preserving flexibility. I call these the contingency components. And I think the contingency components should also be under this near-term need, because you're going to have things that ebb and flow from time to time, whether that's revenue, whether that's federal government grants that are delayed or the process of getting through, the payment hasn't come through yet. You need to be able to bridge these and set contingencies that allow you to continue to move forward even during these disruptive timeframes. So this allows you, by building contingency plans in your short-term, your tribal cash reserves, it allows you to then continue to focus on your long-term economic growth. So your target outcome here is much more stable, liquid, and low risk. And you'll hear more about that later. Because in my opinion, and in our opinion here at IndiWealth, this creates the ability to really focus on those higher expected returns with your long-term capital, because you'll be able to withstand, and not only withstand, potentially take advantage of short-term disruptions and volatility to really extend your profile and extend the growth that you have, because you've already taken care of your near-term needs. So let's talk about those key principles here. One, high liquidity. Again, cash is accessible when obligations are due. You want that to be there when you need it. And so having something liquid and having something that's available to sell and doesn't cause a lot of disruption when you sell it is absolutely essential for these near-term obligation needs. You don't want to be facing an area where you cannot access this money when you need it. Lower volatility and conservative risk, they kind of pair up together, but not exactly. So lower volatility means you're just not ebbing and flowing as much. You want more certainty here. You want to have to reduce that disruption from market swings. So you don't want things that are extraordinarily volatile in this portfolio. You want steady-based returns. You do want to get some level of return for this money. You want this money to work for you. But what you don't want is those big swings, both up and down, with your near-term needs. That should be focused elsewhere. Here you want certainty level of return. And that just leads you to more conservative risk profile, because having a conservative risk profile here allows you to be more flexible and take on greater risk for your long-term needs. But here you want, again, you want stable, you want liquid, you want low risk. And the focus here is really capital preservation. We're protecting the principal. We're making sure that the operational budget is there and accessible when needed. And we're also making sure we have contingency plans for any revenue disruptions or things that we have. And we have that in a very conservative portfolio as well. So what are the things we use? What are common short-term investments that give us that liquidity, that lower volatility, and focus more on capital preservation? Well, common investments, I'll start with cash. There's nothing wrong with holding a component of cash. Cash is the most liquid thing you usually have. And so having it allows you flexibility to do what you need to do. The problem becomes when you hold so much cash because you're using it for quote unquote insurance, or we want to make sure it's there. Absolutely. I totally understand that. But there is a component of limiting your long term growth. And there's also avenues and approaches that you can take that, again, isn't as purely stable as cash, but also provides a little bit return and doesn't experience a lot of downside volatility. So there are other avenues and other investments and other approaches you can take outside of just cash while still holding for the conservative risk profile you need for short-term needs. Other things include CDs and money market funds. CDs, we don't use a ton of CDs here at IndiWealth. We believe the lockup period and the penalty you pay for locking up your money in a CD, we think there are other more liquid avenues that provide that level of return and sometimes even higher levels of return than a CD without that component of lockup that you would pay a penalty to access it. Plus, the administrative component of CDs can be a little bit, hey, 6 months, 2 years, 1 year, and then you're rolling in and you're doing all that stuff. The administrative can be a little bit overburdensome. Again, it's value versus cost. And in our opinion, CDs have certain places, but for the most part, I think there are better avenues and vehicles to take advantage of. Treasury bills and short-term high-quality bonds absolutely can give you a return stream that don't have a lot of downside volatility. So they're absolutely accessible to use. Again, the administrative cost of having a portfolio of hundreds of treasury bills and another hundreds of bonds, I think there are better ways to do it, but these are vehicles that we can absolutely use, or these are investments that we should absolutely use as part of the short-term needs portfolio. Where I say is that exchange traded funds and mutual funds, and especially ETFs, I think are terrific vehicles that incorporate some of these investments. They incorporate some money markets, they incorporate some treasury bills, they incorporate some short-term bonds, but there's also things that they can diversify with a relatively small amount. So you don't have to buy hundreds of treasury bills. You don't have to buy hundreds of bonds and monitor what's going on there and making sure you're diversified and not too concentrated. Underneath one ETF could be hundreds and sometimes thousands of bonds that you're diversified into. So it's a really good avenue to giving you diversification for a low dollar amount. It also is highly liquid. They trade on the stock market exchange every day. And so you can access that money relatively fast without a lot of price difficulty. So that's another good component, is that you'll know what the market price is out there. You know what you're going to get. And there's also ETFs that are designed just for, again, ultra short money market, short treasury bills. There's a lot of ETFs that can satisfy that. And the expense ratios on these ETFs, or the fees that you pay to use them, aren't egregiously expensive. Now, there are some that are higher and some that are lower, and you have to understand that. But we really think at IndiWealth, this is the primary avenue that you can use. And a lot of people, when they think about operating in short-term needs, they think about cash on the sidelines, they think about holding it there. I think you can absolutely use exchange-traded funds and mutual funds. You just need to know which to use. And then when you need that access cash, you just sell them and you provide an easy vehicle to getting it into the account you need, which we'll talk about here later. So we talked about the investments we would use. Here's some of the investments we would not. If you look on the big no, we don't think these are bad investments. We think these are unsuitable for tribal cash reserves. So things of like low credit quality and long duration bonds, we would not be buying them. Here's the thing with low credit quality is you should be paid to take on the risk of default. And the higher the risk of default, the more you should get paid for it. So I understand taking some of that risk, but in the short-term bucket where you want certainty and you want liquidity, lower credit quality just really isn't a fit for that, because you don't want something to actually go into default or risk that the market thinks it's going to go into default and it gets priced as such and you have a severe decline in your price. just because of that lower credit quality. You don't want to take that risk. Similarly, with long duration bonds, I won't get into the weeds too much about duration, but think long duration means greater time to maturity before the bond expires, before you get your money back, if you will. So that long maturity is more affected by interest rate changes. And so bonds have an inverse relationship, which is just a fancy way of saying when interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. Well, historically, the longer the maturity, the more ebb and flow from that. And so a small movement in upward in interest rates for long maturity bonds can have a pretty negative price impact. So again, it's just a misalignment of what you're trying to do with this money. This money is 0 to 24 months. Let's align it in the proper fashion so we're not taking a severe amount of interest rate risk when we need to access that money. Quickly on the equities and illiquid investment side, again, those are fine investments to have, but they are not suitable for short-term operating capital. Equities, a quick analysis, if you look at the history, the average return in the S&P 500 could be about 13% over the last 40 some years. But the problem is the range of those outcomes. On a one-year basis could be as high as plus 60, could be as low as minus 41%. So when you need this money in the next 6 months, can you really stomach the fact that it could be down 20, 30, 40% at this point? I don't think it's worth taking that risk. And again, you'll use equities in the longer term buckets and you'll be able to actually use them better there because you'll be able to withstand that short-term volatility because you've got your cash and your contingency plans in a more certain area of investments. Illiquidity, again, just accessing when you need it is very important. So anything that has a level of illiquidity is probably not worth undertaking. So what are those best practices when we're talking about structuring tribal cash reserves? First, I always say, I think it's best to separate. I think it's best to say, here are the designed separations that we have for operating cash, for a contingency. Now you can combine those, or you can even separate those. Is that this is day-to-day operational cash, this is day-to-day, or this is our contingency planning, and we have two accounts for that. It's absolutely fine. But you need to separate that from your intermediate buckets and your long-term buckets, because from our perspective, that allows you to say very clearly, we have the next 1 to 2 years planned out. We have funds that are accessible, they're liquid, and they're growing at a slightly rate, but they're growing at a rate that, again, we can take out when we need to without taking a lot of severe market risk. Use a dedicated short-term sleeve, whether that's a separate account or whether that's a sleeved component of a broad account. I won't get too far into that, but there is possible to say in one large account, there's a few segmented sleeves. Either way, just delineating that there is operating cash versus other stuff is a way to do that effectively. Align those investments with your expected cash needs. Again, this is the next 0 to 2 years. Something you're going to need in 30 days, some you're going to need in 6 months. Your contingency planning, you may never actually access that, but you may need a substantial amount of it in the next 2 years. So you want to be able to align your investments with those. And again, especially in our opinion, that those investments we talked about before, whether that's long dated bonds, lower credit quality bonds, or equities or illiquid investments, just aren't a fit with that 0 to 24 month time frame that we're putting together for the short-term needs. Keep access and transfer simple. Have the person who is authorized to make these transactions, whether it's the CFO, whether it's the executive director, whether it's the treasurer or the tribal council, have authorized members in the accounts ready to go. By setting up the structure properly at the outset, you allow yourself much greater efficiency going forward. And so as a CFO, as a tribal CFO, if you need access to the money, if you were working with us here at IndiWealth, you would provide us a quick synopsis, whether that's email, we would have a conversation. We would discuss what's needed and where it's needed and how quickly it's needed. And we would sell those highly liquid investments to provide that to an account whether that's a checking account that you use to pay your day-to-day bills, however we want to structure it, we can structure that at the early on at the outset so that the process going forward is seamless, because you don't want this to be difficult to implement going forward. Review regularly. Again, especially with the day-to-day operations. Hey, are there additional costs coming through? Are there other things that we're going to have to plan and design for? On the other side is that, hey, the contingency, maybe in the first couple of years, the contingency plan, we didn't touch it. And so now it's grown because we've been steadily growing that asset pool and we haven't used it at all. Well, maybe we can revisit how much we actually need for a contingency plan and use some of those proceeds for the intermediate or long-term needs. So by reviewing that at least once a year, you can kind of set that up in a better fashion for how your future forecasts look, but also still having that contingency that if your forecasts don't come up correctly, which in a lot of cases they don't, that you have some backdrop and some support in your operating cash budget. So what are the benefits here? I've kind of told you what to use, what not to use, how to set it up, but really, if you did all of that, like, what are the benefits of it? And I think it's confidence in meeting your near-term needs really establishes you to be able to do other things for the future. If you want to set yourself up for long-term economic prosperity, the quickest way to do that is to ensure your next 1 to 2 years are taken care of, because it allows you the confidence to really grow the remainder of your portfolio that you're not going to touch for maybe a couple of years, maybe even not at all. Maybe it's a perpetual fund, these kinds of things. So you want to establish that, and you don't want to be rating those when things go bad. You actually want to probably take advantage of markets on sale so that you can increase your return structure over a longer period of time. In my opinion, you can do that much better if you know you have confidence that your short term is taken care of. Again, it allows fewer forced investment decisions. The markets are going to ebb and flow. And so if the market's down 10, 20, 30%, you want to probably take advantage of those things over a longer period of time by investing more into them rather than selling at inopportune times because you have to meet your cash obligations. So by delineating this and understanding it and having a contingency plan around it, it allows you to be able to better invest for longer periods of time and deal with those markets that are having difficulty. Having a clear separation and reporting and governance, I think that all kind of intertwines. The effect of where your buckets are, your short term, your intermediate term, your long term, and you can also clearly communicate, here's what we've planned for contingencies, here's what we have for operating cash, here's what we have for project-based cash in the midterm, and here's what we have for our perpetual funds, and here's how we're growing those, and here's how we're investing in. It just leads to much clearer conversations for all the constituents, whether that's you as a finance department, whether that's the tribal council, whether that's the tribal committees, or whether that's the tribal citizens. You can clearly delineate what you're trying to do and how you're accomplishing that by setting this structure up at the outset. And again, it allows for greater flexibility in long-term capital. By knowing you have your next 1 to 2 years taken care of, it really does allow you to take advantage of markets on sale and make those long-term investments that you need to grow and prosper over a longer period of time. So again, this is the short-term segment of our time horizon model, which is part of our Treasury Playbook for tribal nations. If you're interested in a copy, I will leave a link in the description below. It has this and it has other information that we feel is essential to tribal governments and tribal entities and native organizations to be able to delineate and set themselves up for long-term economic growth. Download a copy and take a look and let us know what you need. So, thank you very much for joining us. I hope this was helpful. Next week, we will have intermediate term needs. And then the week after that, we'll talk about long-term needs to really kind of focus in on each of the three structures so that we establish that tribal treasury playbook in the proper fashion. But until next week, thank you very much and take care of yourselves.